Hello, and welcome to Credit Compass, your guide to navigating European credit markets. It was a relatively quiet Easter weekend, at least from a market's perspective, though that calm may reflect a degree of negotiation fatigue rather than any meaningful resolution of underlying risks out there. We are recording ahead of the latest Middle East deadline, so developments could shift quickly by the time this is published. That said, I hope you managed to get a break over the Easter weekend and are ready for what is shaping up to be a busy spring. Beneath the surface, several themes continue to build. Geopolitical tensions in the Middle East remain unresolved and continue to feed through into energy markets, and as in-transit supplies begin to slow, European governments are responding with a range of interventions aimed at protecting consumers, from tax cuts to price controls and windfall tax discussions. At the same time, we are seeing ongoing economic performance divergence within Europe, with Spain emerging as a relative bright spot. We also have the Hungarian election coming up, which, while not systemically significant to capital markets, carries important directional implications for Europe. And finally, we will tie all of this back to credit markets, drawing on Jamie Dimon's latest annual letter. So let's dig in. We begin with the ongoing geopolitical tensions and their impact on energy markets. There remains an underlying expectation that the current conflict could be resolved relatively quickly. That expectation is visible in market pricing. Brent crude is trading in backwardation, where near-term prices are higher than those further out along the curve. This typically reflects tight supply conditions today, combined with expectations that those conditions will ease over time. The level of backwardation is the highest since 2022 for the 6-month forward contract. However, the current situation is more complex. While some production has ramped up in other regions to offset supply disruptions, particularly those linked to key transit routes such as the Strait of Hormuz, global supply remains broadly constrained. The war in Ukraine continues to limit available capacity and flexibility within the system, as Russian supply sites have been struck recently, meaning that replacement barrels are not as readily available as markets might hope. The shape of the curve, therefore, reflects a balance between near-term scarcity and medium-term optimism. Markets appear to be pricing two things simultaneously. First, that the current disruption will not be prolonged indefinitely, and second, that once resolved, supply conditions could normalize relatively quickly, potentially even leading to surplus that brings prices down. That said, even if the market is looking through the shock, the real economy is already feeling it, most visibly at the pumps. As a result, European governments have moved quickly to respond. The policy toolkit has been broad, but can be grouped into several key approaches. First, direct price controls. Countries such as Hungary and Croatia have intervened directly in retail fuel pricing by setting maximum prices per liter. In Croatia's case, prices were frozen in early March for a 2-week period and then subsequently reset. These measures provide immediate and visible relief to consumers, but they come with clear trade-offs. By capping prices, governments risk distorting supply incentives and placing pressure on distributors, particularly if wholesale costs remain elevated, as well as stepped pricing once those caps are lifted. Second, price breaks or margin interventions. Austria provides a good example here, combining a reduction in oil taxes around 5 cents per liter with an additional cap on margins across the fuel supply chain. This approach spreads the burden between the public sector and private participants. While less distortionary than outright caps, it still compresses profitability and may have implications for investment and supply over time. Third, temporary tax reductions. These are among the most commonly used tools as they can be implemented relatively quickly. Governments reduce fuel taxes or VAT for a defined period with the expectation that savings are passed on to consumers. However, this comes with a fiscal cost. Depending on the scale and duration, these measures can meaningfully impact government revenues, particularly in an environment where fiscal space is already constrained. There is also the practical consideration that tax changes often require legislative approval, which can delay implementation. In some cases, countries have combined these approaches. Poland, for example, has implemented both VAT relief and capped pricing mechanisms, aiming to maximize consumer protection. There is also a more subtle form of intervention, strategic signaling. In countries such as the Netherlands and Belgium, governments have indicated that they are considering price caps or other regulatory measures. Even without immediate action, this signaling can influence behavior. It effectively serves as a warning to suppliers that excessive pricing may trigger more aggressive intervention, encouraging a degree of self regulation within the market. Beyond pricing mechanisms, governments are also turning to supply side measures, including the release of strategic reserves. This helps to increase available supply and stabilize prices in the short term without the direct fiscal cost associated with tax cuts. However, it is inherently a temporary solution. If disruptions persist beyond the available reserves, additional measures will still be required. At the EU level, discussions around windfall taxes and profit redistribution are becoming increasingly prominent. These measures aim to capture excess profits generated by energy companies during the periods of elevated prices. While they may help to address distributional concerns, they also raise longer term questions. In particular, windfall taxes can disincentivize future investment by introducing uncertainty around returns, especially at a time when significant capital is needed to support both traditional energy supply and the transition to renewables. Profit recycling mechanisms may offer a more balanced approach, but they are more complex and slower to implement. There are also efforts to address the demand side. Lithuania, for example, has implemented a temporary 50% reduction in domestic train fares to encourage a shift away from petrol consumption. While this also carries a fiscal cost, it highlights a broader attempt to reduce demand rather than solely focusing on supply and pricing. This connects to a wider structural theme, the gradual shift toward more sustainable energy sources. Seasonality is beginning to play a supportive role. As we move into a period of higher solar output, renewable generation is increasing. Over the Easter weekend, for example, parts of Europe, including Poland, experienced negative electricity prices due to favorable weather conditions. While these episodes are typically short lived, they do help to offset broader energy cost pressures and illustrate the growing influence of renewables within the energy mix. At the same time, there has been a continued increase in battery electric vehicle adoption. March saw strong growth across major markets, including the UK, France, and Germany. While this is part of a longer term trend rather than a sudden shift, it contributes incrementally to reducing dependence on traditional fuel sources. Now, diving into one country with recent economic performance data out, Spain stands out as a relative success story within Europe. Recent data indicates that the Spanish economy continues to build momentum. PMI readings for both services and manufacturing moved higher in March, signaling ongoing expansion, while these levels remain below those seen last year, suggesting a moderation in growth. They still point to a relatively resilient economic environment. The labor market is particularly strong. Employment increased by approximately 211,000 or around 80,000 on a seasonally adjusted basis, bringing total employment above 22 million, an all-time high for the country. This strength in employment supports consumption and broader economic stability. On the fiscal side, Spain has also made progress. The budget deficit has declined to around 2.3% of GDP. This is better than pre-pandemic levels seen in 2018. In the context of rising energy costs and the fiscal pressures associated with mitigation measures, this represents a relatively strong position. Taken together, these factors position Spain as a key source of support within a broader European economy that continues to face challenges, particularly in larger economies such as Germany and France. Looking ahead to another European Union country, an election in Hungary on the 12th of April introduces an additional layer of uncertainty. Current polling suggests a closely contested outcome. At stake is not just domestic political direction, but also the potential release of approximately 20 to 30 billion euros in EU funding that has been withheld due to governance concerns. If there is a political shift that leads to the release of these funds, the impact could be significant. It would represent a positive shock to the Hungarian economy, supporting growth, improving fiscal dynamics, and likely leading to improved financing conditions. There would also be spillover effects into the broader Eastern European regions through trade, capital flows, and investor sentiment. For the wider Europe area, the direct macroeconomic impact would be modest. However, the institutional signal would be important. A conditional, rules-based release of funds would reinforce the credibility of EU governance, while a more politically driven outcome could introduce longer-term risks. Conversely, if the current administration remains in place, tensions with the EU are likely to persist. This would keep funding constrained and maintain a higher structural risk premium across Hungarian assets. While the broader European impact would be limited, it would reinforce themes of political fragmentation within the EU. All of this brings us to credit markets. This week, Jamie Dimon, CEO of JP Morgan, released his annual letter to shareholders, offering a useful perspective on the current environment. His central message is that several risks may be underappreciated. These include geopolitics, the ongoing energy shock, structural inflationary pressures, and the possibility that interest rates remain higher for longer than markets currently expect. While the global economy has shown resilience, he highlights several structural drivers of inflation, including persistent fiscal deficits, geopolitical fragmentation, increased defense spending, and the capital required for the energy transition. These factors suggest that inflation may prove more durable and that volatility could remain elevated. On private credit, his tone appears somewhat more measured than in the past. He does not express significant concern about systemic risk, but he does highlight underwriting standards as an area of focus. This is consistent with a late-cycle environment where risks tend to build gradually beneath the surface. So what does this mean for credit? Well, we are increasingly seeing a combination of forces pulling in different directions. On one hand, there are reasons for cautious optimism. Energy markets are pricing a degree of normalization, and parts of the European economy, such as Spain, remain resilient. On the other hand, the broader picture is more challenging. Higher energy costs are weighing on growth and corporate margins. At the same time, higher interest rates are increasing the cost of debt servicing. This combination creates a more difficult environment, particularly for the more highly levered borrowers. A key issue is refinancing. A significant volume of high-yield bonds and leveraged loans, many of which were originated or refinanced in the low-rate environment in 2021 and 2022, will need to be refinanced in the coming years. As these maturities approach, borrowers will face materially higher funding costs. For some, this will be manageable. For others, it may lead to increased financial stress, higher default rates, and lower recovery values. In the investment-grade space, these risks are more contained, balance sheets are generally stronger, and access to capital remains relatively stable. However, differentiation is increasing. The gap between stronger and weaker credits is widening, making credit selection increasingly important. So, while markets appear relatively calm in the near term, the underlying dynamics suggest that we may be moving into a more challenging phase of the credit cycle, an energy shock that is being managed but not fully resolved, policy responses that provide short-term relief but carry longer-term trade-offs, divergence within European economies, and a credit environment that is gradually becoming more complex. That's all for this week's edition of the Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macro credit. Until next time, stay curious, stay informed, and stay resilient. The Credit Compass, guide your way.